There are four primary components of a deal when selling your business, and for each of these components, there's a real secret or tip that you want to keep in mind as you're having conversations with people to really get the best results. I'm Arthur Petropoulos, Managing Partner here at Hillview Partners. We're a middle market, lower middle market M&A and capital advisory firm, investment banking firm, helping companies generating $1 million to $10 million a year, pre-tax earnings or EBITDA, sell their businesses and secure capital. In today's video, we want to walk through the four primary components of a deal when you are selling your business. What are the four high-level pillars or variables of the sale of the company? And for each of these, one secret or tip that we've seen from hundreds and hundreds of deals that you should really keep in mind, whether using us or elsewise, to get the best results when you're selling a business. And so for each of these variables, we'll kind of want to walk through the spectrum as well. You'd see on one end of the spectrum what you'd see on the other, and then obviously our tip relative to each. So the first variable, the one that first comes to mind in anyone selling a deal, is the price. And so this may sound very simple, but on one end of the spectrum, you have a low price. On one end of the spectrum, you have a high price. Difference in selling a business versus selling a house or something like that is that the market is not nearly as efficient. There is no Zillow, if you will, that has pricing that you can really get good data on what things are selling, have sold for. And not to mention that businesses are incredibly more nuanced, if you will, as an asset class as well. Therefore, the delta or the dispersion of data points for the value of a company could be 2-3 times the value. You could sell a company for $1 or sell a company for $3, where if you sold a house, you'd sell it for anything from 85 cents to $1.15. Now, that's not to say that the utilization of a broker or an intermediary in a house sale is irrelevant, because no, they can certainly enhance the price far beyond their cost. What the point being is the variation for pricing when it comes to a business is just far broader. And so, tip for this particular variable is don't ask for a price for your business. Let the market dictate it. If the process is done right, and we'll pound the drum on this all day, it's the right narrative to the right audience in the right process. If you get the right competition, the market will dictate the value of the business. If you don't have adequate data points for the sale of a company to sufficiently say, okay, this is where we think value is, based on not valuations written by accountants and attorneys and things that can be helpful but are a little more theoretical, but from true, hard, fast offers from arm's length third parties, that's going to be your best data points. That's what you want to let the market dictate. And if someone really wants to get a deal done and they really need something, and again, because you have access, because you have capabilities, because you have one of these variables that makes it far more appealing for the company to acquire you than build a business from ground up, they're going to pay a much higher price. And so you don't want to have an asking price out there. Let the market dictate it, and if you have the right representation or investment banking from working with you, they will work the market such that the price will optimize and that you will make sure you get the best that the market has to offer. Now, the second variable is structure, right? And so if someone says, I'll give you X dollars for your company, the question is, how much at closing, how much over time? The component that is over time, is it purely just predicated on the passing of time, or is it a seller note, as if it's a loan, holding paper is the phrase you might hear? Is it an earn-out where certain targets need to be hit? And if there are those targets based on things that are easily achieved? Is it just kind of staying consistent with the past, or are you saying, hey, you need to sell us the company and double revenue or EBITDA over the next few years, right? The structure of a deal has a meaningful implication relative to the probability of the outcome. Now, the secret for this one is that price, and we'll discuss this towards the end of the video again, but price and structure are somewhat counterbalancing. If you're willing to take some component of it over time, roll some element of it forward, it can be a leverage tool to get a higher price. Therefore, the tip here is let the confidence in the future of the business dictate or back into the structure you're willing to accept to optimize the price, right? And so if you're selling a business and you say, look, I like the business, it's been a great business, however, the next 3 years, I don't know what's going to happen. If someone runs it really well, it's going to do well, but there's also the risk that it could be run very poorly and not get it. Right? Part of that risk is going to be mitigated by picking the right counterparty, but at the same time, if there's not that level of certainty, then maybe you don't want to take that much structure in a deal and you want to keep price kind of where it is. Alternatively, if you say, look, we've got so much firepower and so much tailwinds behind us that there's no way, or very low risk, that someone could really mess this up going forward. And with the structure conversation, you can have certain rights and controls to make sure that there are some guardrails on the situation. If you're very, very confident, then you can use the structure. If someone says, look, we'd pay 90% at closing, 10% over time. If we were to go back and say, look, we want the price to be X% higher. However, we'd be willing to take maybe 15% after transaction and structure it this way or that way. And it's a more nuanced conversation, but it can be used as leverage in that way. And so what we say with structure is understand the structure, negotiate the structure, and the tip being use your confidence in the future as a counterbalance to try to leverage price up if so desired. Now, the third prong or pillar of a deal is going to be the transition. So if you're selling the business, there's very few companies making 1 to 10 million in EBITDA where ownership is truly passive 100%, doesn't do anything, never visits, never looks at the company. We've seen it from time to time. However, for the most part, there's large elements of the business delegated. However, there's still some role played. And therefore, part of the conversation for an acquirer is always going to be, what is the transition period desired for ownership? So on one end of the spectrum, you could have a situation where an acquirer would say, we'd love it if this person would just keep working on the business for the next 5 years. On the other end of the spectrum, you could have a seller that says, I want to be out of there the day after we close. Now, the reality is that it's going to be something a little bit more tightened in. Oftentimes, if the desire is to exit quickly, we'll have a 1-year kind of quick tapering transition, typically involving kind of a 90-day consistent period followed by tapering and availability for calls or Zoom meetings as necessary. But that being said, there are certain situations where someone says, look, I want to sell the majority of the business such that I can get away from the administrative tasks and I can focus on product development, sales, employees, and building the infrastructure and human capital of the business. And if there's a desire for that, then the willingness to stick around can again be a leverage tool for price. And so the tip for transition is determine the objectives before negotiating, but don't necessarily communicate them. And so we don't mean don't communicate them like be entirely vague, but if someone said, would the seller be willing to stick around for the next 5 years? The response we'll usually give, if there is a desire to stay for some protracted period, for some longer period of time, is to say, look, I think there'd be an interest in an ongoing involvement of the business, but it'd have to be discussed and kind of negotiated in totality with all of the other variables, right? So now, instead of just giving it away, saying, yeah, that's what we want, now it is a leverage tool again, relative, coming back to price, coming to structure. And as you're going to see as we get into the fourth component of this, it's all of these things kind of intertwined in lattice or machine work relative to the overall deal. But that's a tip in that regard. And so now number 4, and lastly, is stakeholder considerations. And really that can be employee considerations to some extent, where people are very involved with the community. Say a manufacturing company that has a plant in a particular city that they want to keep there. But more often it's really the employee base of a business and how does someone want them to be treated. And you know, the notion of the seller just saying, hey, just give me all the money and I don't care what happens to the employees is a complete fallacy. The vast majority, particularly in deals that we work with, because the majority of deals we're working with are not, call it, sponsored deals. They're not owned by private equity, they're not owned by venture capitalists, they're owned by entrepreneurs, families, smaller groups of investors. And when people that have grown these businesses, have relied on their teams to get them to where they are, they want to make sure their teams are taken care of on a post-transaction basis. And so they really do care what's going to happen. So on one end of the spectrum, you could say, I won't sell the business unless I'm assured that these X people are going to have employment contracts for this duration of time thereafter. Or on the other end of the spectrum, you could say, look, I would like it if you could take care of our team, but we understand you're going to own the business. Now, the secret to this component of it, or the trick, is that I think we all have this misperception of Wall Street or Pretty Women or Other People's Money or all these old movies of these kind of bloated companies that ownership would sell the business and the acquirer would come in and slash and burn and fire tons of people. In the modern economy, one of the hardest things for people to do is find good people. We are human capital constrained, particularly in the lower middle market and middle market size companies. So say companies generating $1 million to $200 million in revenues. Finding good people is the hardest thing. I would say all acquirers of the businesses that we've sold in the last few years have said, we're not firing anybody. We're not looking to make any material adjustments to the human element of the business until we really get our arms around it, because it is far harder to find people than to fire people. And so that's one element of it. And then what we'd say is digging even deeper when we kind of do the retrospective and check in with the acquirers, call it a year or two later, and we say, how did this thing happen? How did this thing happen? Most of the people they acquire are really moving up in the ranks, and it's giving them more opportunity to be part of a larger organization. So the secret to this is don't let the stakeholder consideration drive down the price as a seller. And what I mean by this is if a buyer comes in and says, you know what, we can pay this price, we can do this structure, we can do this transition, and we really can't do more because we do want to be deferential to the employees and make sure we keep all of them. I'm not saying that that's BS, but we are in an environment where human capital is constrained. They are not keeping these people on board because it is their good nature to do so. They're keeping these people on board because it is hard to find good people. And so really, from the seller side of things, and when we're representing companies, we're saying we're delivering you a company filled with good people. That is the leverage, not the leverage of saying you're going to do us a favor and keep all of these people because they are good people. So that's a secret in that regard. So let's run through these four real quick and then kind of leave on a parting note summarizing all of this. But the four components of a deal and the secrets relative to each are, first, the price of the company. And secret there, don't go out with an asking price, let the market dictate it. The number one indicator as to whether you're running a real process or whether you're just kind of schlocking a business on a website is whether you have an asking price. I can assure you of that. It's the first conversation we have with almost every single buyer that we're looking at on a deal. It doesn't mean we don't provide guidance. It doesn't mean we don't push people in certain directions and lead them to the conclusion to a lesser degree. However, going out there with a firm asking price like you're selling an apple or selling a house is a sure shot way to people to discredit or devalue the business that you're selling. Second is structure. And from the structural perspective, the secret there is let your confidence in the future dictate the structure you're willing to tolerate and how hard you want to negotiate that, and use it as leverage to counterbalance the price and try to move it upward if the level of confidence is there and you're willing to take that risk. Three is transition. And the secret to the transition is back out from what your objectives are, keep it close to the chest, and then use it as leverage, again, for price and structural considerations. And fourth are stakeholder considerations, and the secret there being the people are an asset, not a liability. The people are hard things to find. They are the difficult components of the business, not the easy ones. We don't live in a world anymore where people are looking to slash and burn and fire people. We're living in a world where they're figuring out how to incentivize, retain, and grow people. So if you have a good team, that is a tremendous value and is an asset and is a leverage point for all of the other variables. So summary point from this, we really want to get across is the four pillars of a deal: price, structure, transition, stakeholders, should be thought of as a cohesive or a comprehensive set of variables that all are intertwined, that are inextricable from one another, and are all kind of levers and pulleys that will allow you to negotiate to the optimal whole deal. And so when someone says, hey, I'll give you X dollars for your business, or, oh, I think we can get you an offer for X, it's a very small part of the overall picture, and it does not include the other key variables that could very clearly make a deal good or bad. And that's why, candidly, in our engagements, the term used to see in a lot of engagements, never in ours, I was surprised to see them when I was on the private equity side or when we were back in my Wall Street days, was sometimes you'd see these must-take provisions where someone said, hey, if I get you an offer of X, you have to take the offer or you have to pay the firm as if you took the offer. We never do that because the price is just one variable. If I said I'll give you $1 billion if you could swim across the Atlantic Ocean, otherwise I'll give you $1, that's not a $1 billion offer. The structure there makes it a lousy deal. If I said I'll give you $1 billion for your company if you work for the next 200 years, that transition makes the price bad. And so, again, all of these things need to be taken into consideration collectively. They all need to be leveraged. They all need to be negotiated, and that's when we'll get the best outcome. So that's a thought for today. Hope the week finishes up well for everyone. Keep pushing forward. God bless. See everyone next time.